If you're in crypto, you absolutely felt it. That massive price drop after October 10th that just seemed to come out of nowhere, it was a total shockwave. But you know what? The real reason behind it is probably not what you think. Let's get right into what really happened.
And just to give you an idea of the sheer chaos we're talking about, look at this number. In just a few minutes, the crash was so brutal it wiped out nearly 2 million accounts. Just poof, gone. It was a lightning-fast event that left everybody asking, what just happened?
Now, usually, when something this huge rocks the market, our minds immediately go to the big stuff, right? Major economic news, inflation reports, some global event. But according to Bitmain chairman Tom Lee, if that's where you were looking, you were in completely the wrong place. The real cause was something way more technical, something hidden deep inside the market's plumbing.
And that's really the heart of the mystery here. If it wasn't the broader economy, what on earth could have the power to cause a meltdown this massive? Well, the answer isn't about investor fear or bad news. It points to a fundamental flaw in the system itself, basically a glitch.
So, here it is. Tom Lee called it a systemic liquidity shock. Now, that sounds complicated, I know, but the idea behind it is actually terrifyingly simple. This entire market-wide catastrophe started from one single point of failure, a tiny crack in the foundation that ended up bringing the whole house down.
And get this, here's the truly ironic part. That single point of failure, it was a stable coin. The one type of asset that's supposed to be the bedrock of stability in the wild world of crypto. The one thing that's meant to be a safe harbor pegged one-to-one with the US dollar.
But this one was anything but stable. I mean, look at this. It's supposed to hold steady at $1, but its value just completely fell off a cliff, plummeting all the way down to 65 cents on a major exchange. This right here, this was the tiny spark that lit the fuse on a massive powder keg.
Okay, so how does one coin failing tear down the entire market? Well, this wasn't a slow burn. It triggered a devastating and totally automated domino effect that just cascaded through the whole system in a matter of minutes.
All right, so here's how the dominoes fell, and it all happened in a flash. First, that stablecoin depegs, which causes an immediate shock to trust. Right away, these automated systems, ADLs, kick in and just start force-closing trades. This puts insane pressure on the market makers, the big players who provide all the liquidity. They have no choice but to start dumping other crypto assets to cover their capital, and they have to do it fast. And that's what creates this vicious feedback loop. The selling pushes prices down, which triggers more automated liquidations, which forces more selling. You get the idea. It's a complete meltdown spiral.
Tom Lee's description for this is just perfect. He said, this is like a market bug. And think about what that means. He's not talking about a bad day for investors or a panic sell. He's describing a flaw in the actual code of the market, a glitch in the financial machine.
Now, a market bug sounds like a very modern, very crypto kind of problem, right? Well, you might be surprised to hear that this kind of systemic failure, it has some pretty infamous relatives in traditional finance. We have absolutely seen this movie before.
In fact, people are drawing a direct line from this event back to the same kind of systemic plumbing issues that caused the 1987 Black Monday crash and even the 2009 global financial crisis. It's this recurring nightmare where the internal mechanics of the market just break down with catastrophic results.
So why does crypto seem to get hit so hard by this stuff? Well, in a way, the crypto market often acts as the canary in the coal mine, because it has less cash sloshing around to absorb big shocks, what the experts call weaker liquidity. It's often the very first place to show cracks when these system-wide problems pop up, sometimes even before the stock market blinks.
So what's next? What's the prognosis here? Well, according to Tom Lee, the damage from a shock like this isn't necessarily permanent, but the system definitely needs some time to heal. His best guess? It's going to take about 2 weeks for the market to fully stabilize and really process what happened. All right, so let's just quickly recap the big takeaways. First, this crash wasn't about the global economy. It was a systemic market bug. Second, the whole thing was triggered by a single stablecoin losing its $1 peg. That failure kicked off a crazy domino effect of automated selling. And finally, this isn't totally new. It's a pattern we've seen in some of the biggest crashes in history.
And all of that brings us to the final and frankly the most critical question. If this wasn't just a random panic, but a fundamental bug coded into the very structure of the market, could it happen again? And what does that really mean for the future of crypto? That is a pretty chilling thought to leave you with.